Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go. Welcome, everyone, to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, joined by Laura Russo.
Hello.
And so my name is Matthew Peck, and actually today we're going to be doing our version of Matt's Markets on the Move. So for all of our listeners, what we do is that on a quarterly basis, we go through what's happening in the markets, what's happened in the past, what does SHP look for right now, and then also what's going to be looking at in the future, along with some questions and answers that we like to take in from the clients. So we like to do this on a regular basis.
Hey, Matt, not to interrupt you, but I had a fun idea.
All right, go ahead.
So for those of you who don't know, we actually do this call for all of our clients, separate video version.
Oh yeah, that's the longer one that has all the graphs.
Version.
It's obviously much more visual, but I'm not sure if it would work here.
What if, Matt, we have Christmas in July and we give it to everybody as a freebie this time around, just to show everyone a little bit of what it looks like for all of our clients who get the actual video version of it.
Oh, so that would be interesting. Okay, so we use the exact same version that we do on our YouTube channel and that we promote to our clients.
Yeah.
Again, that's the one with all the graphs. I mean, that one has a lot more.
That's a fancy version.
It is a fancy version, and frankly, it has a lot more information because it has all of the graphs specifically. Now, it's tough, obviously, on the audio, but that could work.
Yeah, we can just link the YouTube video and provide all the information in the subheading for you guys. We just thought it'd be fun to really provide you with a little bit of a peek under the hood of what we do as SHP advisors over to our actual clients. So we wanted to share that with you guys this time around.
Excellent. Okay, so for all of our listeners, what we're going to do is in a moment, we're going to break and we're going to come back with the full audio and visual version. But certainly let us know how it goes. I mean, send back any feedback whatsoever. Did you like that version? Did you prefer what we did in the past? Whatever that may be. And obviously, we just want to be as engaged as possible. So enjoy.
All right. Hello, everyone, and welcome to this quarter's episode of Matt's Markets on the Move. I'm here with the famous Matthew C. Peck.
The one and only.
The one and only. Thank God for that. I don't think we could handle any more, Matt. I'm just kidding. But hey, we have an awesome show for you today. It's going to be jam-packed. But I always love to start it off with something a little bit fun, Matt. So I have a question for you. You know, I love to keep you on your toes. My question for you is, it's summertime, right? Okay. We're going to the beach. We live near the Cape. So what is your book that you're bringing to the beach with you? What are you going to read on the beach?
I would have to have an umbrella, though. I definitely need a sun umbrella. Yes. Is that in this image?
That's in the image. Okay. You could also have one of those white sunblock noses, maybe one of those safari hats.
Yeah, right.
Go full sun protection.
Yeah, because I'm a big fan of shade.
I asked that question. His first train of thought is, I'm Irish. I need to protect myself from the sun.
Like, do I have sunblock in this scenario? You know? No, but
just tell us the book.
I know, right? But it's funny, the only thing that pops in mind initially, because there's obviously so many good books out there, is that funny story, Laura, is that on my honeymoon, here we are, my wife and I, newlyweds down in Aruba, beautiful, turquoise waters, wonderful beaches, sand in your toes, and I bring with me a hardcover book on the French and Indian War.
Oh my gosh, Matt.
That just shows you how nerdy, like the level of nerdiness.
Romantic he is.
Yeah, exactly. It's not like love poetry or anything like that.
Geez.
No, it is a history of the French and Indian War, which was fascinating.
I'm sure.
Yeah, called the Cousins' War. Check it out if you are a history geek like I am.
That's awesome. And for those of you who don't know, we actually have a separate group chat in the office for all of us readers. It's called We Read SHP, and you can always get some good references there for what to read. Matt always has some really nice history.
Yeah, and I always do like a nerd alert.
Yes, he does a nerd alert for
prior
us.
to posting any books on that chat. I just warn people that it's coming. There's a massive history book on its way.
And I have a dork alert because I'm all about the fantasies. I love a good story. Yeah. So yes, it's a fun time. But let's get serious now, okay? Enough joking around, Matt. So we're going to jump in. And as a reminder of how we love to break this down is that we want to make it easy, we want to make it understandable, is we're going to do 3 segments for you. So we're going to do the past quarter. How did we do? The historicals, if you will. And we're going to go through piece by piece of what our takeaways have been. And then we're going to look at how does that impact us now? What are we looking at as we are in the present moment of the big ticket items? And then we're going to launch off into the future quarter, what we expect, what we anticipate, and as we get closer and closer to some big ticket items coming down the track for us. So we've got a lot to go off of. So Matt, let's just jump right in. How did we do last quarter? It's been a full quarter since we last sat here.
Yes.
What did we go through?
So is everyone in front of everyone's screen what we lovingly call the Skittles chart? So we always like to start with what sectors have done the best and really start off on a macro level. Because we'll talk about certain areas in the future, like growth versus value and certain opportunities and pockets of opportunities that we look for. But as I mentioned, it's first to take a look at what has done well, what cream is rising to the top of 2024, which is amazing too. Is the fact that yes, we're on the back half of 2024, which takes some time, get your mind wrapped around
seriously.
that. Quickly time passes, but yet again, leading the charge for the second year, or at least for 18 months in, from 2023 into 2024, is large cap. We'll talk a little bit about the future, but clear, the Magnificent Seven and the AI revolution is continuing to power the large cap positions as we move forward. Then you have emerging market equity. So think, terms of like Indonesia and Mexico and India, as well as certain countries, developed markets, coming in third. Think Europe and Rome and England and France and whatnot. And then right below there is our diversified portfolio. For all of our listeners and watchers out there, diversified portfolio represents 60% stocks and 40% bonds. Okay. And what we love about it, as you can see, is that sort of, light gray or whitish box is always right in the middle.
Yeah.
Okay. And that's kind of what you expect. I mean, when you have a nice blend of stocks and bonds, you're going to always end up in the middle. You're never going to be leading, you're never going to be at the top, but you're also never going to be on the bottom. And that's the beauty of diversification, is being able to ride out whatever the markets may be, positive or negative. You're kind of stabilized and you're running through there. As we continue on, commodities, high yield, cash is still there as we're getting some pretty good rates of return on money markets. And then towards the bottom, I did want to point out small cap, which I'll get to in the future, but also fixed income. Laura, I'm sure as an advisor here at SHP, how many questions do you get about fixed income?
Oh my gosh, all day long. Yeah, all day.
It's I don't blame anyone for having those questions, because and we get them too, and Team Matt and other advisors here and teams here at SHP. It's because people are always wondering, like, why am I holding this asset that always seems to be dragging me down? That, especially in recent history too. I mean, even if you took a look at 2023, it was on the lower end of things. If you take a look at 2022, it was, it had lost value. So now we're talking 2 years, or even 3 years, if you go further back, that it has sort of been losing value. A couple things to remind everyone as to why we own bonds and what the power of them are. First off is that what's not necessarily represented here is the fact that bonds will pay interest and they'll pay income.
The favorite word.
Yes, right, yield, dividend, interest. The income in the fixed income space is a crucial part of that answer, because now we're in the 4 to 5% range where we are receiving those coupons, getting that yield on a consistent basis, okay? So now we're getting the income portion of it. The other factor on bonds is the fact that if interest rates are cut, then it serves as a capital appreciation. Then it will get a boost to that particular sector, okay? Now, most folks and analysts are expecting at least one rate cut going into the future from the Federal Reserve, but let's just say there's an economic shock, okay? And the Fed has to cut rates aggressively. Well, not only would we receive that income that we talked about, but now we would get a significant capital appreciation, a big boost to that portion of the portfolio, okay? So you can see it as almost like insurance, in the sense that, all right, I'm going to get paid anywhere from 4 to 5%
Right.
to have that in my portfolio, right? And in the meantime, if the economy shifts and shifts in a bad way, quickly, because we all know black swan events can happen, there can be rushes to safety at any point in time. If the Federal Reserve either cuts rates slowly or aggressively, then we have our income plus we have our capital appreciation.
Right.
Okay.
Exactly.
It hasn't happened in recent history, but we try to just advocate patience, long-term views.
Yes.
And that's why we own fixed income, even though it sort of had some rough patches recently.
Exactly. And the easy way to remember it too is the teeter-totter. I know it's like kind of like 101, but basically when it comes to the fixed income, it's going to be adjusted with the rates. It's the opposite, and that's the typical fashion of it. So just think of that teeter-totter, and if the rates are still up, your bonds are still going to be down.
Yes.
But if the rates start going, we're going to have that inverse, and that's where we want to see it. But the yield is a huge piece. I think a lot of people forget about that, is that it's paying you out. You're getting money out of it, and although the performance might be down on it, you're still getting money out of this item.
Sorry to interrupt, I was going to say, and specifically because when people look on their statements or if they look online, they'll see negative and they don't necessarily see that yield coming in.
Right,
so that's, again, why I don't necessarily blame anyone for asking,
of course,
repeatedly asking that question.
And we want people to ask that question. We really do. Yeah, because we like to explain it because we're nerds.
Yeah. We talked a little bit about AI, but why also did large cap do well going forward? Well, let me take a look at both global as well as the United States when it comes to the business and the macro environment and the economic environment. What you're seeing here is the PMI, the Purchasing Managers Index quarterly. And what it looks like global, manufacturing, services, developed markets, emerging markets, US, et cetera. And if you look all the way down, Laura, you're going to see a lot of green, right? France and Germany, halfway down there, they're having a little bit of issues, obviously for reasons we all know on the news, Ukraine and in some of the elections recently in France, threw that country a little into turmoil, political turmoil at least. But in general, you see a lot of green or shades of yellow. You don't see a lot of red. Red is recession. Red is significant difficulty, which means that on a global level, if the global economy is doing well and large cap companies are global companies, right? Then you have a very good economic or a global economic backdrop, okay? If looking further, you take a look at the United States. And right now, you'll see the GDP, which is for Q2 2023, third quarter 23, fourth quarter 23, first quarter 24, and you'll see that growth sort of peaked and now is coming down. Okay, but that's okay. I mean, we're literally on our trend growth line, which is where we should be. And I'll also point out the fact that this is what the Federal Reserve wants. The inflation and the economy cannot burn so hot that we continue to get that 9, 10, 11% inflation that we had. So slowing growth is not necessarily a bad thing at all.
Right.
Now, stopping growth recessions,
Don't want that.
Don't want that, right? Don't want negatives. However, slowing growth is not a bad thing at all. And you're starting to see that. So in other words, it's growth, it's still healthy, it's still moving forward. It might not be as well as it was in the past, but if the economy is growing, profits are there, companies are doing well, and large cap stocks are doing well as well, okay? So we talked about the slowing aspect. All right, well, let's talk about why. Well, certainly with the rising of the higher interest rates that have been there. That's the other part too, just to jump back to the fixed income. There was anticipated of anywhere from 3 to 4 rate cuts this year. It's more like it's like going to be about 1 rate cut at most this year, as much as sort of like the futures market's telling us. So here we have anywhere from 2 years, let's say, of high interest rates. It eventually is going to bite. It is eventually going to slow down the economy, which we have seen, as well as things like when it comes to consumer finances, on the bottom right corner, you see delinquencies are coming back up, which makes sense. People who have auto loans, who try to continue to spend or took out a loan with a high interest rate, they're starting to go delinquent a little bit. Credit cards. Thankfully, they're nowhere near where they were back in 2008. You can see some of those higher levels in the past, but consumer finances are slowing down a little bit, or they're having a tougher time maintaining their standard of living, which means they're going to pull back.
Budgets are getting tighter.
Exactly. So you're going to see a lot less, but just leads to less growth. But that's okay. Some growth is still good, and this type of thing is anticipated. And you're also seeing slowing in the labor market. On the left-hand side, you'll see JOLTS. That's kind of job openings. And you'll see it peaked at sort of an enormous level. And so that just means like how many help wanted signs. What the JOLTS opening is sort of how many people are hanging the shingle to say, hey, we're looking for jobs. We can't fill jobs, et cetera. How many openings are there? Well, look how high it was in March of 2022. And look at where it's now. It's now kind of coming back to sort of almost like a normal trend line, if you will. But that's healthy. Again, that's what the Federal Reserve wants.
Right.
That's what all those high interest rates are doing to the job market, but they want that type of softening.
Exactly.
Because that means that inflation's going down.
Exactly.
It's funny, it's like we want to have our cake and eat it too. It's like, I want the economy to do great no matter what happens, but I don't want higher prices over here, right? It's like, well, we have to kind of find that balance, and that's what the Federal Reserve is charged with doing. Is finding that balance between high interest rates, but what they call the normal rates, right? What's the normal rate for the economy to grow slowly, not inflate too much or not grow too hot, where inflation runs too wild? And so they knew, obviously, they had to do something with where inflation was. And so this is music to the Federal Reserve's ears in regards to the direction of the market. And a labor market, and you'll see like the quits. I love this. I love all the data points. Obviously, again, nerd alert, right? But they talk about like the quit level. That they measure how many people like quit their job, because they think that okay, I can get a better job with higher pay elsewhere, and quits is coming down to normal trend lines. So again, all this data is exactly what the Federal Reserve is looking for.
Exactly.
But it's not falling off a cliff, which means that that's where again recessions would strike. Although it would be good for fixed income because they would cut rates more aggressively.
Right.
So all those bond haters out there, not that you want to root for a recession, but
Wait a minute.
right. That's where it comes.
Please don't do that.
But on the same time, back to the labor market, wages are still growing at a good, consistent pace. On the bottom right corner there, Laura, you see that in May 2024, and some new data is coming out soon, the wage growth is about 4.2%. And so unemployment's kind of coming up a little bit there, that's the black line, which is coming up, and wage growth is coming down, but it's still at a very healthy level. It's still at a level that's above its 50-year average. And so on one hand, we have we have wages growing at 4%, and then when you look at CPI and look at inflation, even headline CPI, if you take a look on the right-hand side, all of the numbers for May are 3.3, 3.4, food 2.1, energy 3.5, headline PCE, and there's so many different indexes that they track for inflation, but all of them are underneath 4%, or even 3.5% for that matter. So that means that a majority of the workers out there, Laura, are getting 4% raises, while their bills are only going up 3%, let's say, and their salary or whatnot's going up 4%. So they feel a little bit more comfortable. And that's a great position to be in for that slow growth. Right. Slow and steady wins the race is sort of what's happening or where the economy is sort of settling down into. Okay. And then last but not least, besides just a good economic backdrop, besides a good labor market, softening labor market, but not weak labor market, we can't do I don't even know how many quarterly market updates and markets on the move we're going to do without talking about AI.
Have to. Yeah.
I mean, it's going to be for the next 5 years, maybe not even longer.
Yeah.
Right.
Yeah.
Right. And so here's some major reasons for it. The first, to talk about how many billions on the left-hand side, $183 billion are anticipated to be spent on AI. As you can see, that grew from last year and only anticipated to grow more. And specifically on the right-hand side too, they talk about what's called AI adopters, right? Where it's like, okay, who's currently using it? And so I'll just pull up healthcare, right? Healthcare, they're currently using it only 5%. that's a long runway to use about all the different healthcare providers that will eventually adopt some form of AI as the technology gets better and as it becomes more specific to each of these industries.
Right.
It has a long runway.
It's not even settled in yet.
Oh, absolutely not. I mean, and that's why there was a great article in Barron's that they talked about how Philippe Lafont, who manages the Kautu, if I pronounce that correctly, forgive me, during Bloomberg Investing. Lafont noted that when the PC was invented, over $100 trillion in today's dollars was invested in CPU infrastructure. So think about all your towers and all the and all the computers that are out there, laptops that we're on right now. Well, he found that they'll all need to be replaced with GPU focus, which is kind of like AI. So it's like an AI laptop or an AI desktop, whatever that may be. And so in his opinion, there are trillions in spending to come. If AI is just like the PC revolution of the mid-90s, early mid-90s, then there's still a long runway of this to go, which is, again, it's all just helping to keep the markets afloat and steady. Because the other interesting part, too, is that this last slide shows the amount of days that the market's moved more than 1%.
Yeah, that's good. Yeah.
And so it's been a very boring market too, right? Which is which is very very uncommon, because even on good years, they'll talk about. Let's see if I can find 2013, which that was 38 days. I mean, I'll go a couple of years, 122 days. I mean, this just shows that certain days the markets are moving more than 1%. And then here we are.
Those are big swings. Those are the big swings.
Those are scary swings.
Exactly.
Those are numbers that any swing over above 1% will get the headlines, right? And we've only had 10 in the first half of this year. So it just shows how calm things have been because of all of those reasonings. The labor market is softening just like the Federal Reserve wants. Inflation is coming down just like the Federal Reserve wants. The global economy is in pretty good shape. In AI, we're still in the early innings of AI, which is helping to drive all of these profits. So that's why leading to recently, at least, just a very calm market as to where we are right now.
Yeah, that's a great segue for us. So let's talk about how things are looking right now, how things are going to impact us based off of all the information that we just took in from the last quarter. How's that going to impact us now?
Okay, so here's where we stand right now, Laura. A lot of questions that we also get is about the price of the market, and the market is pricey. What you're looking at right there is in front of you is that the 30-year average of the PE ratio is about, call it 16.69%, times earnings, and then there's one standard deviation above. And then we're now above the one standard deviation. So it's okay to be within averages, but we are now above average when it comes to a overpriced or overvalued stock market, according to these metrics. Okay. So what does that mean? Well, or why, I should ask. Sorry. The concentration that's happened is off the charts. And concentration, just to kind of really more define that better, is the Mag 7 or the Magnificent 7.
And that's going to be like Microsoft, Google, NVIDIA, all the big ones.
Absolutely. Yep. I mean, literally on the top right corner, they talk about the weight of the top 10 stocks in the S&P 500. Okay. Right now, 37% of the S&P 500 are in top 10 stocks. So it's almost like we have the S&P 490. And then you have the S&P 10, which is, as you said, Microsoft, Google, all those AI guys we just talked about, Amazon, the ones that either are making the chips or have all the data to run the chips, run the processes that drive those AI models or those LLM models. 37% of the S&P 500 are these top 10 companies. Which, and then on the left-hand side, it just shows about how above average, that those companies have. So it's a long, when we say things about concentration and you see these types of charts, what does it mean? It just means that the S&P 500 could be very dependent on how these companies move, because now close to 40%, which has never happened at least since 1996, you have this high level of concentration. So it's worrisome. So now it's pricey on one hand in general, and then you take a look and like, oh my goodness, it's also being driven by these 10 companies, again, for reasons that we talked about,
right.
AI and different things along those lines. So sometimes like, okay, what does SHP do? How do we read information like this? What type of action would we take? Well, on one hand, we're looking, well, actually, honestly, on one hand, but the biggest thing that we look at is pockets of opportunity. Mm-hmm. All right. Mm-hmm. So if we can start to sort of look into the S&P 500 a little bit better, we know what's doing really, really well, as we just talked about. But what's not doing really well? What's dragging down the other 490? Mm-hmm. And is that going to change? Mm-hmm. Will that start to improve? And are they below average? So let's first talk about value versus growth.
Yeah, and I think a good point, and I joked with Matt, is that part of my job is to deglaze people a little. So if you're starting to glaze over, this is what we're...
Yes, this is... I have
we're going to take a quick little digression to explain what he's talking about, because sometimes he speaks another language. There, yeah. So we're looking at value stock versus growth and PE ratio. So PE ratio is your price to earnings ratio, right? So when we're looking at these two segments of stocks, they have a little bit of different treatment when it comes to the PE ratios. So when it comes to a growth, think of growth, there's a lot of earnings potential. So they have high PE ratios.
Correct.
And then with the value, those tend to have lower earning potential, but they're value because they're usually well established and they're good buys. They're our pocket buys that we can get them kind of lower because they're good value.
Yes.
So that's our deglazing moment. Okay, Matt, jump back in.
Well, and to kind of build on that, right, Laura, is that the idea of think of value, right, where there's less growth, but it's a little bit steadier,
yes.
like kind of like more mature companies. And people always joke around about some of the value companies because, hey, even if a recession strikes, you're still going to drink orange juice.
Right.
Right. You're still going to,
We're going to have our cereal, so Kellogg's
yes.
is still going to be doing great.
Correct. And the banks are still going to be there, and you're still going to need lights and utilities and whatnot, right? But their earnings aren't expected to go up like something like NVIDIA.
Exactly.
That is, who knows how much they're going to earn with all the AI information. So that's what we're looking at is, okay, is how does value compare to growth in on average? And then also on the right-hand side, it talks about how, on the bottom right corner, the bottom axis or whatever, it talks about the 10-year treasury rates, what the range is, and then how does growth and value perform in those ranges when it comes to, annualized total return. And it just says, okay, on the left-hand side, it's saying that value is cheap. On the right-hand side, it's saying, okay, if interest rates stay in this range, well, value should do just as well, historically speaking.
Exactly, which is pretty interesting.
Than growth would do, right? And then furthermore, we saw this great article from BlackRock that talked about how, let's see if I can scroll down to it, forgive me. It talked about how the other companies, the 493, on the when it comes to their expectations for earnings growth, going forward, BlackRock anticipates the other 493, kind of like the more value pockets, to have just as much earning growth as the Mag 7 or the Magnificent 7. This wasn't the case in 2023. This wasn't the case in early, Q1. This wasn't the case over the past, 3 months. And it's not expected to really start to flip until the back half of this year. But these are the types of trends that we want to get ahead of.
Yeah.
Right. We don't want to wait until the earnings, because once the market's very very forecast driven, very future driven. So we sort of want to see if we can rotate some of the portfolios to take advantage of some of these pockets before the pockets close.
Exactly.
And then you have to look elsewhere. Okay. Now this is also true when it comes to international. If you look on the left-hand side, look at the international when it comes to there's 2 standard deviations. Again, same idea, the price PE ratio here of the S&P 500 and how it compares to the all-country world index, the ACWI. What happens here, and so international is also 2 standard deviations, or this significant opportunity, in the international space. Now, we have to be careful with what we do. How much, sometimes value can be what's called value traps, which I'm going to explain a little bit here. But it's more about, even though the market might be pricey, not all areas of the markets are pricing them. There might be some advantages that you can take.
Yeah.
That being said, what I was mentioning about the value trap is that there are areas, and you saw this in the skills chart where the small cap had outperformed. Well, there's kind of a reason why small cap, every once in a while, if things are very domestically driven and there's a significant broadening out, you might see small cap do better. But it still has a reputation for having a lot of unprofitable companies in there. Like, look at Current. 44% of the small cap index, close to 50% of it, and in COVID-19 it was up to as high as 53%, are unprofitable companies. Like, literally don't make any money at all. Now they're hoping to grow and to sort of really hit profitability in the future, but still, it's a coin flip when it comes to investing in that space. And so this is what we'll sort of define as a value trap, where it's like, ooh, there might be value there. And then you look under the hood and it's like, well, oh, that's because there's 50% of them are unprofitable companies, right? So that's sort of the give and the take. You look for opportunities, but then you have to dive a little bit deeper before SHP or any sort of portfolio management will start to take advantage of it.
Yeah, and I think that's a good place to also add in when it comes to how we do things at SHP is we do quarterly rebalances.
Right.
So we're not doing day trading. We're not trading stocks every single day to try and get a couple bucks here and there. We're doing these deep dive evaluations of all of the trades that we make. We're looking under the hood, just like you said. And a lot of that comes from looking at the actual balance sheets of the company, the income statements, all of that. And it's a big thing to do. So that's why it takes us the quarter to research all of them and make quality choices in what we're doing.
Well, and I think to that point, I mean, we're not making these quick snap decisions, right? Because trends will take some time to shift. I mean, we're not just sort of getting on one next hot stock tip or whatever that may be. Trends take time to emerge, and trends take time to really manifest themselves before we can take advantage of it.
Exactly, and a lot of the people who don't, look at this day in and day out, they see the big ticket items that pop up on their Bloomberg app and on, all of their financial news tracking, and they say, well, why aren't we investing in this? Why aren't we doing that? And that's more of that behavioral kind of herd mentality, where you're just kind of going with what you're seeing in the moment rather than looking deep down and diving into everything.
FOMO is very strong.
FOMO is strong. That's fear of missing out, people. That is not a financial term. No. That is I think that's a millennial term.
But it could be used for the market. It could be used for if your buddies go to the beach with you, for example. Like, fear of missing out, FOMO is strong.
See, Matt's cool. He's so hip and with it.
That's it. So I would say so that's where we are. So now I think it'd be good to talk about where we want to go.
I love that. Yeah. So we've got the past, we've got the current, the looking ahead. This is where people are starting to get pretty antsy because there's some big ticket items coming down the pipeline. I can let you jump right into that.
Well, yeah. So I mean, I kind of want to break it up to be, because another question that we have is, we'll talk about FOMO, right? And forget about sort of individual stocks. It's more the idea of, okay, the market's pricey. Should I invest in those? Should I invest in the market now? Should I wait for a downturn? What should I do? So we wanted to pull up some slides that kind of spoke to that about, okay, investing at all-time highs, because even myself, I think it's just natural. Like, I want to buy low. I don't want to buy high.
Right.
I mean, that's one of the old, you sell high, buy high, right? That's one of the adages that we all should live by when it comes to the markets. Okay. Well, another adage that we need to live by and to remind ourselves by is the long-term view that you need to have with the markets. And I pulled up this slide because I love this. So it's a lot going on here on this slide, but what it talks about is where we are, sort of in that little kind of diamond there, square, or whatever you want to call it, shows where we are when it comes to the PE ratio. Again, the valuation of the overall market. And then all the other small little diamonds on the gray diamonds there show what the next year brought, the next 1 year brought. And you can see it's all over the map, right? Next year was as high as 55%, and then another year it could have been below as 42% loss. So in other words, over that 1 year, the rate of return could be all over if you invested right now, based on, historically speaking, based on where the market might end up in a year from now, okay? But then look over 5 years. it starts to become a much easier trend line.
Yeah.
Where in most of those little dots and scattered plots, as they're called, are all generally positive.
Yeah.
Over 5 years. Okay, now some are still negative, some are still flat, so it's never perfect, no guarantees. Future results are not guaranteed, and past results are not guaranteed to future, whatever that is. But just shows that over time, things generally end up positive.
Yeah.
And here's another one too that we talked about, that where it's like on the right hand side it talks about the S&P total returns. This is over the past roughly about 40 years. Talks about investing on any day versus investing in a new high. And over 3 months it makes a difference. Over 6 months a little bit of a difference. But over 5 years, it's actually, if you invest in a new high, it actually beats any day. Based on the S&P 500 over those 5 years. And so it just repeats that if you're investing in the market, you need to have that long-term time horizon. If you don't have that long-term time horizon, or if you can't sort of handle the ups and downs and you're looking at it on a daily basis, you sort of need to get to your advisor and say, okay, what could I have that doesn't make me watch this?
Right. And I think a good
daily
piece of this too, and I love that chart with the diamonds, is because it really does show you the impact of looking too narrow. You're looking too closely in one specific time frame. But when you zoom out, and we say it all the time, when you take that 10,000 foot view, you're going to see that it's not as scattered. It's going to be a lot more concentrated, and it's a really great picture for us to be able to kind of keep that in the back of our minds. And a lot of this, for those who are listening, it's also coming up a lot because many people went into cash when everything happened with the market. And I think a lot of people are unfortunately still in cash, and that's why it's like, when do I go in? Because the market's still going up, and it's almost, you have a fear of going in. So this is important.
Well, it's funny you say that too, and I'm glad you brought that up, because that goes back to a point we're making about, okay, how come the market's so volatile, or I'm sorry, not volatile? How come it's been so calm? How come the markets have been so elevated? And a lot of that is because of the cash on the sidelines.
Yeah.
A lot of people are just saying, hey, at some point in time, that cash is going to get put back to work, or it's always going to serve as a backstop, where if the market goes down a little bit, all that cash is going to start to come in. So that's just another reason why it's a great point. That's another reason why the market's as pricey as it is, because everyone's aware that the market, that there's still a lot of cash on the sidelines. And even it's actually a perfect segue into the next slide, because this talks about where, and folks have seen this slide before, and any of our previous watchers, we talked about comparing, okay, when the peak 6-month CD rate, when there was peak interest rates, when interest rates peaked, what happened over the next 6 to 12 months total return, and it compares things like a 60-40 portfolio, the blue S&P 500, pure bond, and then a CD. In cash itself. And it looked back in 84 to 85, 90, 94, and 01 is one of the big outliers, and that was the NASDAQ bubble crash. But in all the other situations, you can see that bonds, S&P 500 or a blend, beat. Bonds, S&P 500 beat, except for 2001, so forth, didn't beat there. But all the other ones, and by the way, the most recent one, 23 to 24, it beat. So outside of the 60-40 portfolio, the S&P 500 beat even the bonds themselves, which we talked about, beat a 6-month CD in that same time horizon. So we updated the slide to show, okay, what about this? If CD rates have peaked, which according to our records did September, October 23, let's apply the same test we did in the past, and history did repeat itself here.
Exactly, and this is huge because there are so many people out there that we're realizing it's almost like the CDs have replaced their investment portfolio. And that's a little bit of a dangerous game to play, in all honesty. And look at the numbers, look at that. That's wild. And yes, CD rates are good. We're not saying don't have CDs, but don't have all of your money in CDs. And that's where we also find there's a big outlier, which is the reinvestment risk that you're taking.
Absolutely.
Is what if the feds come in and do a big rate drop?
Yes.
And your CDs, let's say you have 500,000 in CDs coming due, and now the rates are at 0.5%, 1%, whatever it is.
That's half of what you were getting.
Exactly. That's a big risk that you're taking. So make sure that if you don't have an advisor, get one that knows what they're talking about, and number two, listen to your advisor.
Yeah.
When all this happened, a lot of people came, I want to go to all cash, and we get it. We totally get it, and we don't always have a crystal ball.
Right.
It's easy for us to look back and say, oh yeah, look, the market did great, but in that time, we also didn't know how the market was going to do when COVID happened. But for the people that stayed in cash, it took a big hit on their portfolios.
Well, and also too, I think that's why I talk about the geeky history books and all that stuff. I mean, as you're saying, past performance is no guarantee of future results. We don't know what the future holds, but that's why I rely on history and I rely on this data as much as I can because, okay, it's going to rhyme. It might not be exactly, history is not going to repeat itself, but it's going to rhyme. And if this is what history shows time and time again, we have to rely on that, because we can't predict the future, but that's what we're just trying to learn from so that we give that quality advice and manage the portfolios the proper way.
Exactly. Now, okay, so Matt, we have talked about the CD rates are great, market's at all-time high, good news, good news. You got to have some bad news for us.
So we brought up this slide here, and that's just the slow-moving car crash that is our federal debt and deficit.
Yes.
And what you're seeing here too is actually updated with the potential for the Trump tax cuts, the TCJA, that's the red hand side. So for everyone that's following along on screen, you'll see the red hand side on the top and the bottom shows if there is an extension to those taxes. Okay, I'm sorry, tax cuts. So the first hand side, it talks about the federal deficit and net interest outlies. So you see about the forecast for our deficit and the direction that it's going in is up. And if depending on if those tax cuts do get extended and there's no offsetting spending cuts, that's what's going to happen going into the future. And specifically when it talks about the net interest outlays, think about that. I mean, why this is sort of an insidious thing that's going to get worse and worse when it comes to our debt and deficit is that, well, if our debt grows, then the interest on that grows, which means that we have to now pay more towards the interest to then cover our debts from before. Do you see what I mean? So it's like it just grows and grows because we're not paying off our principal, and now if we're adding to it, it just continues to add fuel to the fire. Now, the debt and the deficit, it's not like an immediate crisis, but it's like this slow-moving crisis. Yeah. And unfortunately, red or blue, we are not, as of yet, electing officials that will address this and speak to this. Because even if on the below you see the net debt, I mean, we're at debt levels that haven't been seen since World War II. Yeah. Now, I get it. If we're fighting a war right now, if we're fighting against Nazi Germany, we need to, spend as much money as we can to win that war, but we're not at war. Right. The economy, like everything talked about, is in really good shape, actually. So it's just, this is the type of stuff that I wouldn't say it keeps me up at night every night, but
some nights.
It does. It worries me because it's just, we just need to address it. And it's like anything in life, it's a compromise. It's going to be maybe potentially higher taxes here or lower Social Security benefits or whatever it may be. I don't have all those answers clearly, but more so that this is going to eventually rear its head in higher interest rates on bonds because they're going to want to, if the United States government isn't fiscally responsible, well, if I'm lending to somebody that's not fiscally responsible, I'm going to charge a higher interest rate, because you've proven in the past you can't handle your stuff. Right? Exactly. So this is the type of stuff that I really worry about. And then furthermore, let's talk about, really, so that's long down there.
So these are the things that keep him up once in a while. Let's talk about what keeps him up every night.
Every night, especially over the next 6 months, or where are we, 5 months, is just the election and the fact that people will have a tendency to vote or to invest as they vote. Yeah. Okay. Love this slide because it just talks about how during the different administrations, just the impact on who's in president, who holds the presidency, and how people feel about the economy. So it talks about President Bush. about how Democrats, the economy was so stinky, it's awful. Republicans like, no, this is great. I love this. All right, well, if you were a Democrat and pulled all your money during that time span, the S&P actually did not do that well because that was the 08 great financial crisis. But you get the idea that, now the flip happened. And now Obama's in there, and the Democrats like, yeah, this is great, best economy ever, and the Republicans didn't. And if they invested the way that they voted or felt about politics, they would have missed out. Flip happened again during the Trump presidency, and the same thing happened again during the Biden presidency. Right. Okay, it's just don't invest the way you vote. Vote the way you want to vote. Right. I want to vote. I don't care what you vote. I do want you to vote.
I'm voting for Matt for president.
Oh, that'd be great. I appreciate that. Hey, I think the one thing we might all agree on is that write-in candidates might actually have a chance
spike up
of any year. But no. And then I just want to show you. Here's a reason why. Because talks about real GDP change. Over different administrations. With gray being divided, blue obviously, and red. And look at the S&P 500. You're going to see blue years. You're going to see red years. You're going to see gray years. You're going to see down. Are going to be some reds and some blues and some grays. And so, really what this chart's telling you is that of course it matters who is in the presidency, but the economy finds a way.
Right.
The economy is filled with the 250 million Americans that make choices every day to better their lives, to better their careers, to better their families, to better their communities. And that's what drives us as a country, not necessarily who's sitting in the Oval Office.
Yeah, that's so good. I love that you say, vote how you're going to vote. Yeah. But don't invest with your voting.
Please.
And it's crazy. We're looking at it, and I was talking to Matt about this earlier. It's like, this is the most polarized we've really ever seen it. And it's hostile. It's a hostile environment out there. Even just the debates, like with the fact that we have two candidates that don't even shake their hands, it's wild. Yes. Just that small gesture right there is very impactful. So we want to encourage people to have a neutral investing mentality.
As hard as it is,
and listen to your advisors, because that's what our job is. We always keep our own political ideas out of things so that we're investing in a way that is beneficial to the client. Now, I think is a good time to probably transition into maybe some Q&As. We've got a lot of great questions that came in. So let's go ahead and skip over to that. We did cover some of this, so we'll probably kind of just, take that point over again. But the first one that we came in, everybody's talking about AI. So one question that was interesting is, are there any European AI companies that we should be on the watch for?
Yeah, so I love the question just because it's very specific. But there is a company called Mistral, Mistral. It was founded by a former Meta and Google executive. It's probably only 2 years old. It's not publicly traded at all. It may eventually be in the future, but Mistral, Mistral, is a French company that is generating some waves. And now the other one I'd add is not really in the AI space, but then ARM, they are publicly traded. They are a sort of a semiconductor design company. So those would be two that keep on your watch list if you are tracking European tech companies.
In your fun accounts, that's what we call it.
Yes, right.
Another great question we had, and we talked about it, was the bond outlook for second half of the year, since the Fed funds rate hasn't really changed much.
Yeah, no, exactly.
And so we hit on that pretty well.
Yeah, I talked about just fixed income. Eventually rates will be cut. And that's why that position, whether it's slowly, which is positive for bonds, or quickly, which is more positive for bonds, not necessarily for equities, because then it means that there's a significant shock. Yep. Economic shock.
Yep, exactly. Another question, again, you guys are really good. All these questions are exactly what we're covering, so this is perfect. They have the right mindset on how to approach this call. So next question was, again, U.S. budget deficit, not good.
Don't get me going again.
Exactly. We beat that one off pretty good. And then we did have a few really great questions just regarding specific people's situations, with HELOCs, Social Security. Great questions there. We would encourage you to talk to your advisor on those, because there's a lot of different outliers that, need to be taken into consideration. So for those of you who might have had a little bit more of those specific questions, feel free to just email your advisor, call our main number, and we'll get a hold of someone for you. But those were the big ticket items, is really, what we hit. A lot of it was the rates, the election, the deficit, all of that is good stuff. So Matt, that's our quick Q&A, but I want to ask, what are some of your closing thoughts? What are we thinking for as we prepare, and we'll come back again in a quarter, but what are your closing thoughts for all of our listeners?
Yeah, so just to kind of go back to the political season, because we're really getting into it, is to try, as I mentioned before, and I'll just say it again, try as best you can to sort of disassociate yourself and not get caught up. I mean, it is so hard because you read, you're an engaged citizen, and so it's understandable to get caught up into it. But as you were saying, Laura, it's a highly polarized society, and it's very sort of depressing at times.
Yeah. But
just think about everyone, all the other Americans that are out there, that are driving their cars, that are doing what they can do every day for themselves and for the community, and that's where I take my solace, every day.
Perfect. I don't know if you guys can see it, but we actually have an American flag waving behind him
That's
right
true.
now. Fireworks, the whole shebang.
It's in my mind right now.
Matt Peck for president, everyone. But hey, listen, thank you so much for joining us today. We are so thankful to be able to even have just a few moments of your time just to nerd out on you, get some good information. And we want to remind you that we're here at any point. If you need anything, call SHP, call your advisor. And if you don't work with us yet, then make sure you get on the line with us and set something up, because this is what we do day in and day out. We love it. It's what we're passionate about. And we want to make sure that we're providing the resources for everyone out there.
Well, I certainly hope everyone enjoyed it. I mean, Laura, what did you think?
I think it's pretty awesome.
I mean, I think it will work. We'll see. But certainly, as we talked about throughout, if you ever have any questions, either about anything that we presented on, or whether it was you're looking for the slides themselves, wherever that may be, certainly don't hesitate to reach out to us at www.shpfinancial.com. But also, too, if you feel like you don't have a good advisor, if you feel like, or whether you are doing it yourself and trying to manage all of this information and world, very complex markets, and the world's only getting more complicated and polarized, Laura, as you were mentioning. If you're just looking for a second opinion, right, a second set of eyes to say, okay, maybe I'm not getting the type of advice clear and concise, and that's helping to steer me through those complex times. Again, pick up the phone, reach out to us, go online, www.shpfinancial.com. We're always here for you. Be well, everybody.
Thanks, guys. Have a good one.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.